Welcome to Alternative Investing. I'm Mark Bunting. With me is my co-host David Kaufman. He's president of Westcourt Capital. Now, this is the show where we shift our focus away from stocks and bonds to explore investment concepts that help you break away from the pack and potentially capitalize on some big gains. On today's show, myths about Canadian hedge funds. We'll look at facts versus fiction in exempt products, niche investments, and hedge fund strategy. First up, though, let's learn some more about my co-host, David Kaufman. Nice to see you, David.
Thanks. Great to be here.
Now, this show's been on for a while now, but let's refamiliarize people with what exactly you do, because you're in an interesting niche.
That's right. So I'm the president of Westcourt Capital Corporation, and technically we're an exempt market dealer, an EMD, which means that we have a license to sell exempt product, which means essentially product that isn't sold through prospectus, that isn't publicly traded. And what our firm focuses on is essentially the due diligence of both managers and investment funds in that space. And that's a very big space, of course. So we specialize in two areas, basically, which is the first is real estate-related income funds in Canada that are private that tend to either focus in the debt area, mortgages, or the equity area, which would be REITs. In addition to that, we do a lot of work on hedge funds, trying to discover which ones are running the strategy du jour, which is probably the most appropriate at that time from a tactical perspective. And then we provide recommendations to our high net worth clients, either directly or through their advisors, as to what we recommend that they should own in their portfolio to diversify their asset base.
Now, hedge funds will be a big theme in this show. We'll get to that in just a second. But let's talk about some of the shows coming up where we're going to be doing some of the topics.
Sure. First of all, we'll definitely talk about the notion of the exempt market in a macro sense. What is the exempt market? And it's alternative investing is sort of unhelpfully defined as everything that's not stocks, bonds, or cash. So that can be everything else that's investable. And that is a big set of items. But the big ones that you hear about a lot are things like real estate, private equity, precious metals, commodities, managed futures. And these are areas that some of which use derivatives, some of which are direct long investments, but they're not in traditional vehicles. And we'll be discussing how it is that essentially fund managers invest in those assets to diversify away from the typical risks that are related to public investing.
And we'll also be discussing more niche-oriented areas, more sort of esoteric things like wine, for example.
We can have some fun with that. And actually, it's a very serious business. So you have wine, art, Canadian farmland, which we've discussed in the past, which is a very hot topic right now. We can discuss Vulture Funds, which are these funds that accumulate investor capital and go and invest it in places like Arizona, Florida, California, Nevada, buy up real estate, take advantage of distressed situations. Other types of opportunistic, it could be collectibles, anything in that zone. And you'd be surprised, especially internationally, how many funds have cropped up that deal in those niche products. And it'll be very interesting to us to explore that.
Now, as we said, David, we'll be talking a lot about hedge funds. A lot of people know about them. There are also misperceptions, which we'll talk about. Take us through some of the areas we'll be discussing.
The key differentiator that everyone should note about between hedge funds and mutual funds, which of course everyone knows about and most people own, are the use of leverage, which of course gets a lot of airtime, the ability to sell short, that is to sell stock rather than go long in a position and buy stock, and the use of derivatives. Sometimes they can be very complex structured products. And what we're going to want to do is look at hedge funds from different angles. The first would be from the angle of the fee structure, the service providers, because these days, of course, everything from the prime broker, the auditor, the legal department that's used to survey these things are vitally important. We also want to talk about the issues of regulation, compliance, how advisors look at these funds in various ways, and of course how they're distributed. That is how they end up being sold to members of the public, whether they're high net individuals or others.
And all sorts of different strategies, too, among these hedge fund managers.
That's right. I mean, there seems to be an infinite number of strategies. What you see today is the emergence of multi-strategy managers, which essentially is another way of saying that they take an opportunistic, tactical approach to investing in 1 month or 1 quarter and 1 year in an opportunity where they perceive to be where assets are undervalued, and they can extract value from that and extract alpha, which is manager skill, and really hedge funds are all about alpha.
And David, you're pretty tapped into the financial community, so we're going to be having a lot of interesting guests coming up the next many weeks.
Yes, we are. We're going to really focus on everything from, today we're talking about fact versus fiction in the hedge fund world. We'll be talking about everything from managed futures, private equity, real estate, different strategies. We're going to talk a lot about due diligence because it's very important for investors to be able to know how to do some of their own heavy lifting, and if they don't do that, whom they can turn to help them with that process. And as we said earlier, we're definitely going to turn to some of the niche investments to have a little bit of fun in a more exotic nature.
All right, David, you mentioned hedge funds and some of the myths, some of the fact and fiction. We'll delve into that when we come back. We've got two guests who will be exploring hedge funds myths which refuse to die, and we'll discover why these misperceptions persist. Welcome back to Alternative Investing. I'm here with David Kaufman, the president of Westcourt Capital, my co-host. Today we're talking about myths surrounding Canadian hedge funds. And at this time, we're joined by Michael Burns, partner with Macmillan, specializing in securities law, hedge funds, and structured products, and Peter Hayes, a partner with the alternative investments practice at KPMG. Welcome, gentlemen.
Thank you.
So let's run down this list of hedge fund myths, and we'll find out if they're fact or fiction. We'll start with Canadian hedge funds. Are they unregulated? Is that true or untrue?
Well, absolutely, it's untrue. Certainly compared to the United States, we have a much higher degree of regulation in Canada. And I would think that for the viewers at home, an obvious comparison would be that the average hedge fund manager has the same amount or number of registrations as a traditional mutual fund manager would have. To run a hedge fund in Canada, you need now at least 3 different registrations. You need a portfolio manager registration to advise the fund. You need an exempt market dealer registration to sell units of the fund to investors. And now you need an investment fund manager registration as well to manage the day-to-day business of the fund.
So the proficiency requirements are obviously much higher in Canada than elsewhere because this myth has to come from somewhere. And so, of course, we hear all the time, especially in the U.S., that U.S. hedge funds are totally unregulated. So is that true?
That's not true either. There is regulation in the United States, and it's becoming increased in its force now with the Dodd-Frank Act coming in. But the U.S. regulation is more focused on registering with the SEC and then on compliance functions as opposed to proficiency, which is one of the hallmarks of Canadian registration.
It is a strong myth, and I think it's important to debunk it. I'll share a story. I was at a capital introduction event a couple of weeks ago, and there was a panel on family office investors. And there was one from Europe that made the statement, we don't invest in Canadian hedge funds because it's much less regulated than in the U.S. And my jaw dropped, and you could have heard a pin drop, but it couldn't be further from the truth. And if that's the perception out there, especially outside of Canada, you can imagine what the perception is even within the country.
Okay, what about the perception among, I would think, the average retail investor who may think that hedge funds are inherently risky? They point to 2008, where a whole bunch of them blew up. What about that myth?
I think risk in any investment depends on what you're investing in. So I think broadly speaking, it's false. The first hedge fund or the classic hedge fund is actually there to hedge against risk so that you produce an absolute return, and in down markets you don't lose all your money. I think that sort of hedge strategy is definitely less risky. Yes, once you start shorting securities, you're going to have more risk and you're going to have counterparty risk, but generally those sorts of absolute return strategies are there to mitigate those risks.
And in leading up to 2008, in 2006 and 2007, when we had a raging bull market, is it fair to say that investors who had outsized returns, which we now know were probably the product of what's called levered beta, or just the use of a lot of leverage, for lack of a better term, that it was probably unrealistic for them to expect to have a nice soft fall when the market would finally crash?
I think that's true. I think one thing to stress as well, though, when we speak about hedge funds, is that hedge funds are a broad asset class. And within the hedge fund family, there's a wide variety of strategies that are employed by the managers. And so there are some strategies which are riskier or at the riskier end of the spectrum. And at the same time, there are other strategies which perform quite well depending on the type of market that you're experiencing. And what we saw in 2008, specifically with Canadian hedge funds, is that they performed very well compared to the market as a whole and compared to a lot of other investment classes. In fact, I found that some hedge funds were victims of their own success. They wound up being a source of liquidity for large institutional investors who may have had assets frozen in the asset-backed commercial paper freeze that happened during the same time.
All right, gentlemen, let's move along to another myth. And speaking of Canadian hedge funds, are they generally long-short funds? Is that all they do?
This is definitely probably another myth. There certainly are long-short funds out there in the Canadian marketplace, and historically there have been lots of those. What we see, especially in the last few years, is the broad spectrum, the broad suite of products. There's lots of global macro, there's lots of credit, there's lots of special opportunities funds. So, yes, I think the myth is false. I think back to 08 briefly on this point, what that demonstrated and what the lesson people learned was you can't just put your 10% allocation to hedge funds and think you're diversified. All of a sudden, if that hedge fund was long equity leveraged 2 times, all of a sudden you were doubling down on equities and you got burned. So people are saying, okay, I can't just allocate to hedge funds. I have to look and see what I'm actually investing in underlying that.
And going back to the Alfred Jones model of what a hedge fund is, I define hedge basically as that if you have a true hedge in place in any kind of bet or any kind of trade, that it's impossible to win every bet on the table. And that's sort of the definition. And the idea, of course, is that it will subdue losses when they occur, but it will also make the gains somewhat less exciting when they come along. And to Mark's earlier point, there's no doubt that the hedge funds that got the most press in 2008 in this country had enormous amounts of leverage and in many cases suffered many times the losses that they suffered, that say the TSX suffered, which meant that the investors who didn't redeem had a very, very long road back.
Would you agree, and moving along to another possible myth here about hedge funds, that people find them opaque and they find them maybe intimidating and, again, inherently risky because of that?
I wouldn't say that's the case because I think there's a veritable font of information that's out there concerning hedge funds or a specific hedge fund that you may be interested in investing in that you could look to find the information that you need to make an informed investment decision. For example, the vast majority of hedge funds that are offered in Canada are offered under an offering memorandum, and offering memoranda have to contain certain disclosure levels that they can't have a misrepresentation in them. And a misrepresentation is both a misstatement of material fact, but also an omission to include a material fact that would be relevant for an investor.
That's interesting. I spent a lot of time reading offering memorandums, and one of the things that I've discovered is that the language in them appears to becoming more and more vague. They say we're a multi-strategy fund, which, as we said earlier, is sort of a license to do whatever it is that the manager thinks is the right kind of investment approach at that moment in the cycle. And so, Peter, does the existence and the emergence of multi-strat funds make the transparency a little bit less valuable to the investors?
I think it's like any product, it's buyer beware. And if you're willing to give your money to somebody who has that kind of ability to invest where they think the opportunity is, then you should take on that risk.
All right, you know what? We want to talk Bernie Madoff. Let's just touch on it here briefly, and we'll continue after the break. But let me back into this one. How badly was the hedge fund industry hurt reputationally because of the Bernie Madoff situation, whereby many people thought he was running a hedge fund?
My view, and I think everybody understands Madoff a lot better, obviously it wasn't a hedge fund, and hedge funds were investors just like pension plans were and institutional investors were and fund of funds were. I think it's to a broader point, and perhaps more recently with the Galleon decision last week, where one of the principals was found guilty on 14 counts, will likely serve 15 years. It's an investment industry issue. It wasn't a hedge fund issue. Fraud happens in all types of investment vehicles, regulated and unregulated, as does insider trading. So, yes, it's a bit of a black eye when you have a hedge fund manager or some sort of exposure to hedge funds involved with it. At the end of the day, I think it's good that the public sees that these people are being prosecuted and serving real time.
All right, gentlemen, we'll take a short break. We'll continue with myths about hedge funds and a little more talk about Bernie Madoff after this.
David Kaufman is one of Canada's leading experts on alternative investing. He is the president of Westcourt Capital, a registered exempt market dealer.
Welcome back to Alternative Investing. I'm here with David Kaufman, president of Westcourt Capital. He's my co-host. And back with us are Michael Burns, partner with Macmillan, specializing in securities law, hedge funds, and structured products, and Peter Hayes, a partner with the alternative investments practice at KPMG. We are discussing hedge fund myths. We left off with Bernie Madoff. We don't want to talk too much about him, but Michael, you've got a point to make about Madoff and the hedge fund industry?
Yeah, I mean, Bernie Madoff was as much a hedge fund as Donald Trump was a bona fide presidential candidate.
There you go.
You know, I think it comes down to, and again, it's a consistent theme this evening that, you know, you can't paint all hedge funds with one brush, and Madoff was painted with the hedge fund brush, and he wasn't a hedge fund. He was a series of managed accounts. That said, I think it was very instructive from the Madoff experience that it showed us that if one exercises the appropriate levels of due diligence, or any level of due diligence, on a manager, you can certainly find out a lot of information. And if people had looked into Madoff with any degree of studied due diligence, I think they would have seen that it was a house of cards.
And as we saw, Harry Markopolos did look into it, and regulators still turned a blind eye. Let's move along. Canadian advisors, again, is this a myth or not, fact or fiction? Canadian advisors are anti-hedge fund in terms of recommending them to clients.
I don't think that's actually, that's a yes and a no, I would say, from my perspective. There's certainly a large number of financial advisors that I'm aware of that do allocate to hedge funds. But it is also fair to say that the majority of advisors aren't quite there yet. So I think part of it is an ignorance on their part in terms of hearing what they hear in the media, believing what they hear in the media, and not being willing to delve underneath the surface and look into what a hedge fund is really about and do the legwork that it needs to understand the product.
There does seem to be that uphill battle that whether or not the advisor knows the difference between a real hedge fund and another fund claiming to be a hedge fund or not, they know that their clients, see the media as well, and that if they want to approach some of these alternative investments and hedge funds in particular with their clients, that they're going to have the uphill battle where their clients assume that means more risk rather than less risk. And Peter, what do you see what the manufacturers of these products, the hedge fund managers, doing to try and address that gap with advisors in this country?
Yeah, I think that, like Mike said, it is a true-false answer. Part of it is, where's the demand? Is the advisor going to push the demand down, or is the demand coming from the actual end investor? And it's not coming from there. So perhaps things like this will help educate the broader public a bit more. At the end of the day, it's like any product, especially for a new product or a small manufacturer, it's hard to get shelf space, especially when you have a couple of very large brokers that control distribution. So you have to work very hard as a new manager to get that shelf space. I think they're getting it, but they have to work pretty hard for it.
And then, of course, we end up with the catch-22, is that institutions for sure say you have to be around for 5 years, you have to run $100 million. And the answer, of course, is, well, you can't get that large if you don't have investors, but you won't have investors unless you're that large. We do, however, have a lot of evidence that shows, and I'm sure you can speak to this, that young hedge funds, if they have the appropriate expertise and experience in the manager's suite, often can outperform funds that are much, much larger.
Yeah, that's what many studies show, especially not even just startup, but small, more nimble managers can do that. So it is a catch-22, and certainly particular to the Canadian market, it's been very hard historically for Canadian managers to get Canadian institutional allocations. We're seeing that change a little bit now, which is promising, both fund of funds and pension funds, but it still is a hard battle.
Michael, would you agree that it's difficult for Canadian hedge funds to raise money in this country?
It is. I mean, you start with the proposition that we're a relatively small country. And we have a small population base, we have a small accredited investor base, which is basically the class of investor that invest in hedge funds. When you look at the institutional question, the very large institutional investors in Canada have typically run their own prop trading desks. And so they are very familiar with the Canadian market. They trade in the Canadian market. They know it very well. And what I keep continually hearing from those types of investors is that we can generate our own returns from investing in Canada. We don't really need to allocate to Canadian managers to get exposure to Canada. So they tend to look to foreign managers to get that exposure in areas where they're not expert.
But when you're talking about allocation, I guess it really starts with allocation, because if an investor, say non-institutional in this country, takes a look, we can virtually guarantee that most Canadian investors have a 60-40 split between equities and fixed income, because it seems in this country as though that was brought down from Mount Sinai on the tablet, 60-40. However, if we look in the rest of the world, and I know that KPMG has issued reports to this, that institutional and high net worth investors around the world have very large allocations to alternatives generally, to hedge funds specifically, and in many cases to Canadian hedge funds.
Yeah, no, it's true. And I think Canadian institutional investors, especially pension funds, are fairly sophisticated. Certainly the larger ones have their own internal departments that deal with hedge funds specifically. But it is an area that I think you're going to see more of, both in Canada and globally, as interest rates are very low and the servicing costs and the gaps between liabilities and assets are growing. The benefit of being a pension investor is that you have a much longer horizon. You can invest in some more illiquid strategies at times, like the private equity and perhaps some of the less liquid hedge strategies. So we are seeing increases, and that will drive growth.
Let's continue with our myth busting here. Canadian hedge fund fees are too high. I think for the average person, they think, well, what I hear is it's 2% off the top and 20% of profits. Is that standard? Is that true? False?
I think at the risk of losing all my clients, I'd say absolutely false. But, you know, the reality is that I think any investor was willing to pay for performance. Certainly, as institutional investors continue to drive the growth, they will tend to drive lower fees, but not the inherent model. The inherent model of a fixed fee and then a performance fee that's variable, I think that's here for good.
And I think that an intellectually honest manager will always, of course, show their performance net of fees. And what I often say to clients and other interested parties is that if you knew today that net of fees, of whatever the fees are, that you could be up 10 or 12 or 14% or whatever it is that you expect to be up, would you do it? And the answer, of course, is yes, because that's what you're trying to do. But I guess that people can't get away from this notion that if they have to give up 20% of their profits, that somehow the manager's just making too much. And we don't really see that as much in the mutual fund space where there's no such thing as performance fees.
No, that's absolutely true. And delving below the surface here again on the performance fee issue is that not all performance fees are the same either. There's sometimes there'll be hurdle rates, there will be adjustments, there'll be catch-ups to the performance fee if a manager hasn't made it. So it's very important to read the disclosure documents for that fund to understand fully the performance fees and how the fees are paid and when they're paid and when, more importantly, when they're not paid.
Can you please just define hurdle rates and high water marks so everyone knows what we're talking about?
Certainly, yeah. A hurdle rate will be a set rate of return before the performance fee kicks in. So, for example, if you have an 8% or a 6% return hurdle rate, that means the fund has to return 6% to the investor before the performance fee starts to get paid. Mm-hmm. High water marks are take track of the fund's performance over a year or over a course of years, and the fund has to perform to that high watermark level again before performance fees get paid.
Okay, just enough time to one more myth here. Fund of funds charge fees on top of fees and therefore are too expensive. True or false?
Again, I'll say false and truly believe false. Fund of funds certainly got beat up a lot in the crisis because the certain issues of transparency and liquidity came to the forefront for them especially. I think fund of funds have always played an important role in the growth of this industry, and I think they will as well. I think people are willing to pay for what they provide, which is due diligence, which is manager selection and oversight. And I think as long as you understand what you're getting and the fees that are there, I think that they will be very important, especially for first-time investors.
All right, the last word goes to you, Peter. Thanks very much for your time today.
Thank you.
Peter Hayes, Michael Burns.
Thanks very much for having me.
David, nice job. I think we did a pretty good job, or you guys did a pretty good job busting the myths of the hedge fund sector. That's all the time we have for today's show. Thanks a lot for joining us. If you've got a question about alternative investing, email us at alternativeinvesting@bnn.ca. Thanks for watching. We will see you next week.